It's Ginger Bell, and I am here today with Mark Gagliardi, and we are talking about the role of an underwriter. So, Mark, thank you so much for joining us today.
Thanks for having me.
You know, there's so much that goes into underwriting a file. And, you know, one of the things I think it's important for a new loan originator to understand is what the role of the underwriter is in the transaction.
Understood. The biggest role of an underwriter is to assess the risk with any loan. And so we're making sure that the customer will pay back the loan, that the collateral for the loan is enough to secure it, and that it meets all guidelines set forth by the parameters of either the government agency that it's being sold to or the individual investor that it's being sold to.
Right.
So our job is to make sure that the loan meets qualifications, meets industry standards or investor standards, and is approved based on those.
Right. And you know, one of the things too, you talked about the underwriting guidelines as far as the loan program and then also the investor. Are those always the same?
Not the same.
Not the same.
Not the same.
So how can they be different?
Basically, Fannie Mae and Freddie Mac and the government agencies, whether it's FHA, VA, or USDA, set forth guidelines or parameters for underwriters to follow. Those are public, it's public information, so
Right.
loan originators should know them also.
Right, so it begins the foundation then.
Correct.
Okay.
That is the minimum standard, so to say, and it's a guideline, not a rule. So we as underwriters look to see if income, assets, credit, collateral meet those guidelines. And really we're the second set of eyes, or really the third set of eyes that see that file. The originator is where it starts.
Right.
They're the first ones to pre-qualify and to ensure that it meets guidelines. Their processor then picks up the ball, and that's the second set of eyes.
Right.
Before it ever gets to an underwriter, a couple people should have already looked at it and determined that it meets guidelines.
Right.
Overlays is what we call investor guidelines, usually are a little more in-depth. There are some investors that don't like certain things, and so they put tougher restrictions.
Okay, so like maybe we have the foundation then as far as what the guidelines are for the loan program that the government sets. And then on top of that then we would have an investor guideline to maybe put a baseline as far as maybe a credit score.
Correct.
Okay.
Correct.
And so those are then called overlays.
Yes, ma'am.
Okay, which
Yes,
makes
ma'am.
sense because you have the base and then you have the overlays.
And they're usually addressing some risk in a loan that investor doesn't want. An example would be FHA could say our minimum credit score is 580 with a minimum down payment.
Right.
Some investors will say we'll take the loan if it's over 600 or 620 or 640, and knowing those investor guidelines or investor overlays are important for both the loan officer and underwriters, because again, if we approve a loan with a certain credit score and then pass it off to an investor, they're just going to send it back to us as a loan that's not viable.
Right.
And that will cost the company money and in the end give headaches.
Right, absolutely. So being educated in those loan programs are important, not just from the standard, but also then from each investor that originator may be working with.
Yes.
Which may be one lender or maybe on a third-party basis to be able to work with a variety of lenders.
Yes.
Okay. So, Mark, we talked about having that foundation as far as knowing guidelines. And so once that foundation is in place, now the loan originator is going to structure the file and they're going to send it into the underwriter. So what are the three most important things that they should focus on in structuring that file?
It's many things, so I don't know if I can detail it as three.
Such an underwriter.
Well, I think what happens in any loan file, you have anybody's life, because what we're doing is we're taking a client who has a life
Right.
and presenting that to an underwriter in the form of paperwork. So
Right.
bank statements, pay stubs, W-2s, tax returns. There are often, each individual is unique. And
Right.
so you may bank different than I do. You
Right.
may get paid different than I do.
Right.
So I think what happens is it's very important for a loan officer to put together a file that makes sense to an underwriter. If the paperwork behind the customer for income is sketchy or unique, they should explain it. And so I always suggest to new loan originators and all loan originators to put together a cover page that discusses the big four. Credit, is there anything unique about credit?
Right.
Income, is there anything unique about income? Assets and collateral, those 4 components, which we call the building blocks
Right.
of a loan file. If there's any weaknesses, address it, so that when an underwriter opens up the file and sees pay stubs that are handwritten, they've already...
Why? Yeah.
Why? Because we're going to ask that question. Most people have an automated payroll company. However, smaller contractors or small employers,
Right.
they'll use the old-fashioned payroll book. Again, it requires additional documentation. The loan officer should know that based on the guidelines.
Right.
So there are, I think, many things that an originator needs to focus on. The best being prep the underwriter for what to look for. If they know in advance that there's a wage garnishment, if they know in advance what it's
Right.
for and why, then the questions and concerns that an underwriter might have are alleviated to a certain extent.
Right.
And again, if the documentation explaining them will lead to more of a chance of the loan being approved, less chance of a suspension or denial, which again, an originator doesn't want to hear those words, but in reality, that's it's how well they prep the file, how well they prepare it, because really what you're doing is you're saying to an underwriter, please approve this loan, and we have to make a determination of will they pay it back, do they have the ability, the capacity, and the willingness to pay that loan back.
Right.
Based on paper. Most times the originators have talked to the customer, met the
Right.
customer, whereas we're just looking at numbers and credit reports and credit scores. For us, it's make it come to life, make the
Right.
customer come to life so that we understand who they are and why they're buying, why they're refinancing, what created any problems in their life or challenges in their loan profile.
Right.
I think that's probably the number one thing that a loan officer can do, is just communicate to the underwriter the story behind their customer.
Right. And I love the way you talk about the story, because I think sometimes in the transaction, especially when we get one removed, like the underwriter is.
Mm-hmm.
So the loan originator is having that conversation, the real estate agent's having that conversation. But then when you get into underwriting, you're not having that conversation with
Correct.
that individual. So building that roadmap, almost like building a case.
Yes.
To where you can look at that. And I love what you talked about in letter of explanation, or what we call an LOI, to be able to explain, the information and go through that. One of the things about being an underwriter is being able to be subjective and to look at the information, because obviously the role of the underwriter is to make sure that you're protecting the lender or the investor. So what about your job do you find most challenging?
Well, naturally, any loan officer that brings in a file wants that loan to be approved.
Right.
That they've conveyed confidence to the customer that, hey, we'll get you your house, or hey, we'll get you the money to pay off your debts, or whatever it is in the scenario, whether it's a purchase or refinance. I think that the hardest part for us is trying to explain to loan officers why something doesn't meet guidelines, or what additional documentation they'll need to get the answer they want. Because if a file is put together well and documented well, it will be approved if it meets guidelines. It will be. I think what happens is the most challenging part of our job is the loans are brought in halfway done. It's like a half-baked cake.
Right.
And then we are tasked with making a decision with half the information. And so when in doubt, most underwriters are going to lean towards conservative, because our job is to protect our company. It is to protect the end investor, whether it's Fannie or Freddie, one of the government agencies. That is our job. Our function is to assess risk. And if we don't have all of the facts, that's going to lead to the answer that most people don't want. The biggest challenge, I think, is, again, every loan officer thinks their loan is the most important, their client is the most important. They're all important.
Right.
But you will have a lot less headaches if you put together the complete puzzle, so that your underwriter isn't trying to figure out exactly which ends up.
Right. So that segues into the next question, and talking about the file flow, because obviously the file goes into the underwriter. Very seldom is it one time, because often what comes back is conditions or steps.
Yes.
So what, and I think you said a lot of it, but probably to recap, what they can help as far as file flow to keep the transaction going.
It's a challenge because in any loan transaction there are a lot of moving parts. And so I think that getting as much information up front from the customer in writing, not, well, he told me, or
right.
we hear it all the time. She told me that it works this way. That's great. Without it in writing, we can't put that in a file.
Right.
Well, there's hearsay involved, and the loan officer said.
Right. So again, building that case.
You must build the case, and you must build it with documentation, evidence, so to say.
And
proving.
early, so build it up front.
Correct.
Rather than coming back.
Correct.
And building it later on.
Correct. In other words, a loan officer, the sharp loan officer comes in the door with a loan file that has 2 months bank statements. They have already looked at them and addressed any large deposits or large withdrawals.
So look at it is the key too,
Correct.
not just collect the information,
Correct.
but to actually look at them.
Correct.
Okay.
And loan officers, when they're busy selling, they have a different skill set and they have a different responsibility than an underwriter.
Right.
They have a processor that helps them piece together the puzzle, but the more they bring in, the more questions can be answered at their desks before it gets to my desk.
Right.
Because then they get upset that we asked for it. Why did you deposit $6,023 on the 5th? Why did you come back on the 10th with another $8,000? We need to address any large deposits. The loan officer knows that. They should address it in advance.
Right.
But they wait, they hope we won't find it. That's
cross
not
the
our
fingers,
job. We'll
no.
find it. So we find it, we request that additional documentation, and that creates a time lag where now the loan officer has to go get it, bother the customer for it.
Right.
Oh, that nasty underwriter asked for this, that, and the other thing. They explain that to the realtors as, oh, those pesky underwriters. Most of it is known in advance.
Right.
So if you review the documentation, why did the income from 2012 go down in 13 when everybody else is hoping to make more money? Answer the question before I ask it,
Right.
because we're going to ask, why do we have declining income? It's an important consideration in a loan file if the income's declining. Why is the credit sporadic? Why, you have to address everything.
Right.
And so what happens is I think that most loan officers do a pretty good job at piecing together the bulk of the information. They look through most of the information, but they don't look through it the way we do, which again, we have a different responsibility and we have a different skill set, and because of that, we're detailed on what we ask for. And again, if they addressed it coming in, it would not come back and forth between underwriting and processing or underwriting and originators that many times. However, in defense of them, they have a hard job because people don't live their lives about getting a mortgage. All of a sudden it's, hey, I want to buy a house.
Yeah.
So we go and I say, well, what happened 2 months ago in your bank account? Oh yeah, I forgot about that. Forgot about all the overdrafts or bounced checks. We ask those questions because we're looking to see if the customer is stable.
Right.
And believe me, people have things go on in their lives.
Right. Life happens.
Life happens.
Yes.
And so if you document it and explain it, we understand it. It's not the first time that somebody lost a job or went through a period of illness where income got disrupted and therefore things happen. But if it's explained, I can't just arbitrarily say, well, I was sick that 6-month period, so I didn't go to work for 6 months. We kind of want more.
Yeah.
That's pretty sick.
Are you better now? Yeah.
Therefore, we'd like to see some kind of documentation that supports that.
Right.
Because I could just lie to you. Liars have been known to do that every once in a while.
Yeah.
So have loan officers.
So again, getting back to that LOE, the letter of explanation, right?
Yes.
Okay.
Mm-hmm.
So how do you like to communicate with loan originators?
Depends on who the originator is.
Okay.
Most originators, we normally, and it depends on company and the size of the company, the scheme. Most underwriters talk to processors more than originators.
Okay.
There are originators that we'll have conversations with, that I will have conversations with.
Right.
Most of the time it's by email because, again, if a file's put together well, there aren't that many conversations. If a file is brought in and it's a train wreck and it's poorly documented, and then that loan officer wants to argue the point of, they'll focus in on the one issue when there's 17.
Right.
And so you could lose half a day arguing with certain loan officers or certain loan originators that just want to argue. And they really, it's just too much time.
Right.
Too much time and energy. If a loan comes in well done and well presented, it'll get the right answer with limited additional documentation necessary. Most of the time, if originator was honest with themselves, they would understand that they should have gone an extra mile to clean it up with letters of explanation from either the customer or even themselves.
Right.
So the ones who we talk to the most are the ones probably doing the poorest job on the origination side.
Interesting. Yeah. So again, it goes back to building that case
Yes, ma'am.
to be able to build that roadmap. So what makes a superstar loan originator? We've talked about communication, we've talked about putting a file together. What else besides those things are important?
Superstar originators often are, they're all very detail-oriented. They're very aggressive. And remember, there's a skill set. Your top originators are great salespeople.
Right.
And great salespeople have a sales skill set.
Mm-hmm.
They can bring the business in. The best originators are the ones with the highest close volume, close ratio.
Right.
In other words, not bringing in loans that can't be approved. They know their guidelines as well as I do. And they're the best to work with because we don't have to have an argument over
Right.
why I need certain documentation. They know I need it, and they go get it, or they have their processor go get it. They don't make excuses. They communicate well. They present a great loan package, and most of the time their loans are approved, and it's not by accident. They know their guidelines, and that's what makes a superstar is somebody that they can go out and sell it because they completely understand it. They know what to expect from me. They know what to expect from underwriting. And if we have a difference of opinion, they're level-headed enough to set out their argument or their case, and most of the time it's presented well enough where we change our minds. We get swayed often
Right.
by any originator, but surely the superstar originators, they know their business. They know their guidelines. They don't guess. They don't guess.
Right.
Because there's more to this than ratios and appraised value, loan to value. There's a lot more to it, and they understand it. So they prep their customers for what's going to be needed,
Right.
and they don't submit it without it. And so I think that the superstar originator is just, they're aware of what we would expect, and they get it and present it so that they get the right answer every time.
Right.
That's your superstar originator.
Right.
And that's, as a new loan officer, that's what I would focus on. Learn your guidelines, know them inside out. That way someone like myself can never say, your loan's been denied.
Right.
We don't want to deny loans. We're not in the business. We make money, just like you, we make money making loans.
Right.
The company wants to make good loans. Every loan has an inherent risk to it, every
Right.
loan. The best of customer can lose their job tomorrow or get sick tomorrow.
Right.
But we need to make sure that that customer, at the time that we approve the loan, is viable and they stable.
Right. And that's
So-
it. It's looking for that stability. So you talked about knowing the loan programs. How often do you see a file come in that maybe should have gone into a different loan program than what it's in that would have made a better benefit for that borrower?
Sometimes,
Sometimes.
frequently, especially not so much about suspended or denied, more about maybe what was right for the customer.
Right.
The lower credit scores, conventional lending has changed to the point where they don't like the lower credit scores. They want stronger borrowers. So the FHA for the first-time buyer, you can have a sporadic job history. You can have $12 in the bank and get 100% gift funds. You can have lower credit scores, et cetera, et cetera. What we see is people trying to push someone into a conventional loan program that probably isn't strong enough. That's probably the greatest.
Right.
Just, hey, I had a conventional loan 5 years ago, I want another one because I don't like the evil PMI.
Right.
And so the loan officer gets channeled by the customer. Sometimes it's the customer saying, I don't want one of those. And the loan officer saying, well, okay, we'll try this. We'll try it this way.
Right.
Okay.
Right.
It's not exactly the way to do it.
It's like a self-diagnosis.
Yes.
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 But I think for the most part, most loan officers put them in the right program. It's just then documenting it to make it work.
Right.
It's not as big a problem as it used to be, but I
Right.
do think that it still happens. And again, that's the customer sometimes drives that, the realtor sometimes drives that. and the loan officer's either experience or inexperience drives that too.
Right. So again, knowing all the different loan programs, whether it's a VA, whether it's an FHA, whether it's a USDA or conventional, and which one's going to be the best for them.
Yes, ma'am.
So very important. If I were a new loan originator coming into your office and asking you to mentor me as an underwriter, what would be the one thing that I could say that would capture your attention?
That's a hard question because really they'd have to say, I am willing to sit here and listen.
Okay.
Listen. Because loan officers love to talk. They're salespeople. They
Right.
love to hear themselves talk. They want to show me that they know what they're talking about.
Right.
I think that loan officers, especially new originators, need to listen to everyone in their office. They need to listen to their fellow loan originators to learn from them. They need to learn from their sales managers, trainers, compliance folks, and underwriting staff. But the biggest thing you can do is listen and take in as much information as you can, but you also need to temper it from where it came from. In other words, well, Joe's a superior loan officer, he's doing really well, and Joe said it works this way. Look it up. The seller servicer manuals are out there,
Right.
all the guidelines are out there. This is not secret information that underwriters have. We have information that you have access to.
You're going to
So-
go to the same resources and guides that they're going to go to,
Yes,
right?
yes.
Interesting.
And we're not going to interpret it differently unless they want to take a shortcut, which is sometimes what happens. And
Right.
again, I think the biggest thing a new loan officer could ask me to get my attention would be that they're willing to listen. They're willing to learn and listen and ask questions, but listen to the answer. Often we're asked questions, and 3 weeks later they come in with a similar loan file with a similar problem, and we have to give them the same answer we gave them 3 weeks ago.
Right.
Why do we need
So
that?
it's retaining the information.
You're going to see it again. Trust me, you're going to see it
Right.
again. That's probably, I think the thing that bothers underwriters the most is you are going to see this again. If somebody was turned down for lack of income or ratio that was 59, it's going to happen again.
Right.
So when you come in with a 62, you're going to get the same answer.
Right.
And so you need to work on how to make them qualify.
Right.
Again, there are things that can be done on the front side of the process before it gets to me to clean up a loan file.
Right. And it may not take long either.
No, ma'am.
Well, and I think mentoring is important, so I thank you for that. And
No problem.
indulging me. But it's important for a new loan originator who's getting started in the industry to be able to find those mentors, to have
Yes.
those conversations, because that is truly how we learn, is through that expertise.
Yes.
And I think to your point of being able to listen and retain is very important and very valid.
Mhm.
So Mark, thank you. We've covered a lot of information, and we value your expertise and your insight into that.
Thank you.
And so, our takeaways, obviously having a conversation with an underwriter is a lot. But beginning with that foundation, knowing your guides, to be able to provide that information up front so it builds the file flow and makes the underwriter's job easier in the end, and of course the loan originator. So thank you very much, Mark.